Michelle Kaufman is a teacher in Denver. She makes decent money. She's not reckless with her spending, and over 3 years, she paid $18,000 toward her credit card debt. Her balance when she started? $15,000. Her balance after paying $18,000? $14,200. She paid more than the original debt and still owed almost everything. That's not a math error. That's not her fault. That's the system working exactly as designed. You've been told that credit card debt is about personal responsibility, that if you just budget better, pay on time, and avoid unnecessary purchases, you'll be fine. The financial advice industry has built an empire on this narrative. Dave Ramsey has made millions telling you to cut up your cards and drink tap water instead of lattes. But what they don't tell you is this: even if you do everything right, the game is rigged, and it's rigged in a way that's perfectly legal. Michelle's story isn't unique. It's becoming the norm, and the mechanism that trapped her is the same one quietly draining your bank account right now, whether you realize it or not. Here's what happened. In 2022, Michelle had a Capital One credit card with a $15,000 balance. Not great, but manageable. Her interest rate was 19.99%, high but standard for credit cards. She made her payments every month, sometimes more than the minimum. She was doing what she was supposed to do. Then she was late, once, 6 days late on a single payment. Capital One's algorithm detected this immediately. Within one billing cycle, her interest rate jumped to 29.99%, 10 percentage points. No warning, no negotiation, just a letter in the mail explaining that her account terms had changed. Michelle didn't default. She didn't miss multiple payments. She was 6 days late once in 3 years, but that was enough. Here's where it gets worse. Capital One's system automatically set her minimum payment at 1.5% of her balance. That's $225 a month. Sounds reasonable, right? You're making payments, you're chipping away at the debt. Except you're not. At a 29.99% APR, 87% of that $225 goes straight to interest. Only about $30 actually reduces the principal balance. At that rate, it would take Michelle 47 years to pay off $15,000. 47 years. She'd be 93 years old. And she'd pay over $60,000 in total, 4 times the original debt. Michelle did the math herself one night. She pulled up every statement from the past 3 years and built a spreadsheet. She tracked every payment, every interest charge, every fee. When she saw the trajectory, when she realized she was essentially paying rent on her own debt with no end in sight, something broke inside her. She posted her credit card statements on TikTok in late 2023. The video went viral. Millions of people saw the math and realized they were trapped in the same cycle. The comments section filled with identical stories. Different banks, same pattern. Different amounts, same trap. One commenter wrote, "I've paid $12,000 on an $8,000 balance and still owe $7,200. I thought I was doing something wrong." Another, "20 years. I've been paying on this card for 20 years and the balance has barely moved." These weren't financial failures. These were people following the rules and losing anyway. The credit card companies had found the perfect loophole, and it's not just Capital One, it's all of them. Let's talk about the numbers they don't want you to see. The average credit card APR hit 27.8% in the fourth quarter of 2024. That's the highest rate since the Federal Reserve started tracking this data in 1994. 30 years of records, and we're at the peak right now. If you carry a $10,000 balance and pay only the minimum, which most people do, you'll pay $28,448 in interest over 42 years. You read that right. 42 years. You could raise a child from birth to adulthood twice in the time it takes to pay off one credit card at minimum payments. But here's the part that should make you angry. That same $10,000, if you invested it in an S&P 500 index fund at the historical average return of 8%, would grow to $54,274 over the same period. The difference between those two scenarios is $70,579. That's not just the interest you paid, that's the wealth you never built because the credit card companies got there first. You're not just losing money, you're losing generational wealth, the ability to retire, the ability to help your kids with college, the ability to own a home. All of it evaporates because of compound interest working in reverse. The banks know this. They've known it for decades. They've designed every piece of the system around it. Remember the Card Act of 2009? That was supposed to fix this problem. Congress passed it after the 2008 financial crisis when everyone was furious at the banks. The law banned arbitrary interest rate increases. It required clear disclosures. It was supposed to protect consumers. Politicians held press conferences. They promised accountability. Senator Chris Dodd called it the most sweeping reforms of credit card industry practices in history. President Obama signed it into law with great fanfare. The public was told the problem was solved, but it left a loophole. It's called universal default, and it's still perfectly legal. Here's how it works. If you're late on any bill, not just your credit card, but your electric bill, your phone bill, your car insurance, the credit card company can raise your rate. You could have a perfect payment history with them. Doesn't matter. They're allowed to monitor your entire credit profile and punish you for mistakes made elsewhere. Between 2022 and 2024, 42 million Americans had their credit card rates increased under this loophole. 42 million people. Most of them never missed a single credit card payment. They just tripped up somewhere else in the financial system and the credit card companies pounced. 64% of major credit card issuers still use universal default. Chase, Bank of America, Citi, Discover, all of them. It's standard practice. And once your rate goes up, it almost never comes back down. The banks will tell you this is about risk management, that they need to protect themselves from borrowers who might default, but the data doesn't support that story. The Consumer Financial Protection Bureau found that most people hit with universal default rate increases never actually defaulted. They kept paying. They just paid more. It's not risk management, it's profit maximization.
But wait, there's something even more insidious happening here. You've been told that Americans are resilient, that the economy is strong, that consumer spending is healthy. The mainstream financial media repeats this constantly. The stock market's up, unemployment's low, everything's fine. Jamie Dimon, the CEO of JP Chase, said this during an earnings call in January 2023. The credit card business has never been more profitable. We're seeing record net interest margins, and the consumer continues to show resilience in making those minimum payments. Resilience, that's the word he used. Translation, people are trapped, but they're still paying. They're running on the hamster wheel, and the wheel is generating record profits. 6 months after Dimon said that, credit card delinquencies hit 8.5%, the highest level since 2011. People weren't resilient, they were breaking. But as long as they kept making those minimum payments, the banks kept smiling. JP Morgan's credit card division saw profits jump 47% in 2023. In the same year, the average cardholder's debt load increased 32%. The banks won, you lost, and they called it resilience. Think of it like this. You're a hamster on a wheel, and that wheel is sitting on a treadmill that's moving backward. The hamster wheel is your minimum payment. You're running as fast as you can. The treadmill moving backward is the compounding interest pulling you further from the finish line. And the speed control on that treadmill, that's the credit card company, and they can crank it up whenever they want. No matter how fast you run, the treadmill accelerates just enough to keep you in the same place, or worse, moving backward. The only way off is to jump, pay a lump sum. But most people can't. They're too exhausted from running. Now zoom out. Total credit card debt in the United States hit $1.13 trillion in the third quarter of 2024. That's trillion with a T. For context, that's more than the entire GDP of Australia. It's more than the combined GDP of Switzerland and Sweden. But here's the part that history keeps whispering. In the year 2000, the average American credit card balance was $3,000. At minimum payments, it took 7 years to pay off. In 2024, the average balance is $6,500, and because of compounding APR increases, it now takes 17 years to pay off. The debt load doubled, the payoff time more than doubled, and the system designed it that way. This mirrors the installment debt crisis of the 1920s. Before the Great Depression, Americans were drowning in installment loans for cars, appliances, and homes. The loans were structured in ways that made them nearly impossible to pay off. Families bought refrigerators and radios on credit, thinking they could manage the small monthly payments. But the interest compounded. The terms were confusing. The contracts had hidden clauses that allowed creditors to seize goods and demand full payment at any time. When the stock market crashed in 1929, millions of Americans defaulted simultaneously, not because they were irresponsible, but because the debt structure was unsustainable. The banks folded, the economy spiraled, credit froze, and the nation fell into the worst economic collapse in its history. We're seeing the same pattern now, except it's happening 3 times faster. And this time, it's not installment loans, it's revolving credit, which means it never ends. There's no final payment, just an endless cycle of interest accumulating faster than you can pay it down. The Federal Reserve Bank of New York released a report in late 2024 warning that credit card debt levels were approaching systemic risk territory. They didn't use those exact words, but that's what the data showed. When a significant portion of the population is trapped in debt that mathematically cannot be repaid, the entire system becomes fragile. One unexpected economic shock, one wave of layoffs, one spike in living costs, and millions of people will stop making even those minimum payments. The banks will take losses, credit will tighten, and the dominoes start falling. The credit card companies have built a system where your debt is more valuable to them than your payoff. They don't want you to escape, they want you making minimums forever. That's the business model, and it's working. Michelle Kaufman figured this out the hard way. After her TikTok went viral, she got advice from financial counselors and decided to stop playing the game. She called Capital One and demanded to speak to someone in their debt resolution department. After 3 transfers and 40 minutes on hold, she reached a supervisor who offered her a settlement. Capital One agreed to accept $9,000 as payment in full. She borrowed the money from her parents, paid it off, and closed the account. She's out now, but it cost her thousands more than it should have, and most people don't have family members with $9,000 sitting around. The system only offers escape routes to people who already have money. If you're truly trapped, truly unable to come up with a lump sum, you're stuck, and the banks know this. They count on it. So, what do you do? First, understand the game. You're not failing at personal finance. The system is designed to trap you. Knowing that changes everything. It shifts the shame and the blame where it actually belongs. Second, if you're carrying a balance, your minimum payment is a trap. Pay more than the minimum. Even $50 extra a month cuts years off your payoff timeline. Focus on the highest interest rate card first. Avalanche method. It's math, not motivation. Every extra dollar you put toward principal saves you $3 or $4 in future interest. Third, if your rate jumps, call the bank. Seriously, most people don't know you can negotiate. Ask for a rate reduction, cite your payment history, tell them you're considering transferring the balance to a competitor. If they refuse, actually do it. Balance transfer cards with a 0% introductory rates exist specifically to poach customers from high-rate cards. Use that leverage. Fourth, stop using the card while you're paying it off. This sounds obvious, but it's the step most people skip. You can't outrun the treadmill if you keep adding weight. Freeze the card in a block of ice if you have to. Delete it from your online shopping accounts. Make it physically difficult to use. And fifth, once you're out, stay out. Use credit cards strategically, not as an extension of your income. Pay the full balance every month. The moment you carry a balance, you're back in the trap. The system resets and the cycle begins again. But here's the unresolved question. If credit card companies can legally trap you in debt that compounds faster than you can pay it off, what else in the financial system is designed the same way? Your car loan? Your mortgage? Your student loans? The answer is more than you think, and the housing market might be the scariest example of all, because while credit cards can destroy your monthly budget, the mortgage industry has figured out how to trap your entire financial future, and the mechanism they're using makes credit card interest look generous by comparison.